Okay, so this is that awkward moment where we wonder if we're live, and it looks like we probably are now. So we're talking today about e-commerce lending, but not the stuff you would normally think of. We're talking about how to enable an exit to happen, i.e. to sell your business or acquire a business, either two sides of the same coin, obviously, by using debt. Debt's got a bad name, but actually the serious e-commerce operators I know use it and use it wisely. So today we're going to be talking with Stephen Speer from e-commerce lending on that important subject. Stephen, welcome to our live/podcast.
Michael, thanks for having me.
Pleasure. So if you are watching live, feel free to put any comments in. You may watch it live or even on the replay, and we will try and weave them in if they make sense. Obviously, comments please restricted to the subject, which is how debt funding can help sell or acquire a business, not should I be selling on eBay, or random questions, please. Occasionally that does happen. So relevant questions we can weave into the show. If not, then pop them in and Stephen or I will try and deal with them after the show. Other than that, we're going to do our usual practice of recording a podcast live. So Stephen, are you ready to rock and roll on that?
Ready to go.
Here we go. Ladles and jelly spoons, boys and girls. Let me do that again. Get the video on my side. Ladles and jelly spoons, boys and girls, welcome to the 10K Collective podcast for 6, 7, and 8-figure Amazon sellers and business owners of e-commerce businesses. Today, we're going to talk to Stephen Speer from e-commerce lending. It's not lending in its usual form. Most people think of lending as a way to fund inventory or other operational things. But today, we're going to be talking about how that can help exit a business, i.e. sell it, which is when, if you need educating these days, about 2/3, maybe even more of the total money you'll ever make in a business will come through that exit. So it's really worth knowing how to make sure that exit actually happens. Stephen's a 28-year veteran of the lending space. E-commerce lending has lent over $300 million with an M. So that's lots and lots of experience brought to the table. So Stephen, welcome to the show. Thanks so much for coming on.
Michael, thanks for having me.
Pleasure. So we've got a bit of your CV, so I guess we know you're expert already. So let's plunge into the topic. First of all, we're talking about how financing can help exit a business. What is exit financing, and how does that differ between the usual lending that we're used to for operations?
Well, in the sense that ultimately, as a seller, what can you do as a seller to exit with as much profit or as much net proceeds as possible? And to be able to do that, one strategic way is to be able to open up the buyer pool quite a bit, which will push the price that you sell your business quite a bit higher. And part of that is the ability of a seller to offer financing, not from a seller note perspective, but be able to have the business that he or she operates qualify for financing. So when a buyer comes in, there's financing available for that purchase. And generally, when there's financing available, it does push the price point quite a bit higher because obviously it exponentially grows the buyer pool. So we work with sellers in preparing them for their exit from that standpoint. And oftentimes, Michael, quite a bit ahead of their exit. It could be a year or two out, but we help them get certain things in place to be able to, again, shore up financing for any potential buyer buying that person's business.
Very interesting. And it does kind of make sense, I guess, that it's not the same, but just to reach for things that I guess we're all familiar with, a mortgage on a property or real estate, as you call it in the States, even though you don't have real anything because it's a royalty. But anyway, property, real estate, if you are only looking for cash buyers of a, say, $3 million house, then it's going to be a much, much smaller pool of buyers than if they can get a mortgage. Now, obviously, normally the buyer in that case is the person who has to pre-qualify for the lending. So you're kind of almost on the opposite side of the scale. So just trying to wrap my head around this. Why is it that as the buyer, you would be the person arranging finance? Wouldn't that normally be the person, sorry, as the seller, the person with the property you're selling, in this case, the business? Why would it be you organizing it and not the buyer?
Well, there are two pieces of the puzzle when it comes to business acquisition financing. One is, does a business qualify for financing? And the other piece, does a buyer qualify for financing? Whereas when you purchase a property, it's really it's the buyer. Does the buyer qualify to buy that property with a mortgage? Yes or no? So with business acquisition, it's both things, because you can have a very well qualified buyer, but if the business doesn't qualify for financing, then it really doesn't matter.
Okay, so if the buyer qualifies, so this is okay. So basically, talk me through the basics of this. I understand the power of meaning that people don't have to put down $3 million in cash or cash equivalent in one go, because that means that or 10 or whatever it is we're talking about. I mean, that does bring us to a simple question, which is, what size businesses are we talking about that this applies to?
We lend anywhere from $500,000 up to 250 million, and we have two different programs. Some are more geared towards U.S. citizens, and where our capital access fund, generally it's $7 million enterprise value and up, and that's open to the world. So it allows buyers to be able to purchase purchase a business, up to 80% leverage, with up to 80% leverage. So you may have somebody that has the ability of maybe buying a $3 million business in cash, but what does it look like with the same amount of money being able to buy maybe a $10 million business by the use of a loan facility? So that's where we come in.
Yeah, and obviously there are a lot more people in the world with $3 million to spend on a business than there are 10 or something. Yeah, it makes sense. So I can understand the basic argument. So how does it look, without getting too into the weeds? Obviously that's your specialism, to guide people through that stuff and make it happen, I suppose. But the seller decides that they want to make the buyer pool bigger and thus push up the value of the business. So how do they go about it? What are the basic steps?
What we do is review the financials of that business, because ultimately lending is all about the financials of a business. Be it review their tax returns, review their P&L statements, etc. That's a lot of it. As you know, a lot of businesses, especially in the online space, they kind of start off kind of husband-wife type of situation, and then before they know it, they have this enormously profitable business worth multi-million dollars. And oftentimes the bookkeeping of that business is not entirely straightforward. So we help with that. We help put together their financials. Sometimes we even pull in CPAs to be able to help with that. And that's ultimately it, because lenders lend based on the financial performance of a business. The business could be wonderful, but if it doesn't show profit, it makes it impossible to short financing for that buyer.
Yeah. And by the way, and I'm not sure in what sense a business is wonderful that doesn't have good profits, but I guess it could have beautiful products and be serving the world well, but that's kind of a charity masquerading as a business, isn't it? Okay, so I guess who would be able to do this? We talked about the size of business. You talked about, I mean, you guys are based in the US, so that some US citizens can go sort of a bit smaller. Are there any other sort of things that would mean that who should be even considering this, is I suppose what I'm working towards? Who is this for and who's this not for?
Yeah, I would say anybody, in looking at your audience, primarily in the UK and elsewhere outside the United States, I would say our capital access fund, where it's basically a business that's going to be sold for roughly $7 million and up. Again, we have sellers reach out to us. We review the financials. We review their exit strategy and try to give some sort of guidance. So when the time comes for their exit, everything's laid out, everything's straightforward, and they're able to exit with as much money in their pocket as possible. And that's a service we provide to sellers. And on the buyer side, as sellers have interested buyers, we're able to vet those buyers for the sellers or for their brokers. If they're using an intermediary, we work with the intermediary to be able to vet the buyers as they come through as well.
Makes sense. So, I mean, I guess my question really is, let me try and home in on, so that's who's eligible, but let me ask a different question. Who do you think should use debt financing to help sell their own business, and who do you think should not be doing that? So not irrespective of whether they can, doesn't mean they should, right? So who should be doing this?
Well, I mean, ultimately, every seller wants to increase the buyer pool. So I would say it's open to anybody. If you're trying to sell your business for $10 million or something of that nature, and the business and you're trying to sell it to someone ready to stroke a check, your buyer pool drastically decreases. So ultimately, if we're trying to get as much on your exit as possible, financing, being able to finance a buyer is the best way to open up that buyer pool. So
Okay,
there's really
so I
no
guess-
instance where it doesn't make sense.
Yeah. Yeah, that makes sense. I guess it's asking a lender whether people should be lent money is probably a silly question, but I guess, but what you say makes a lot of sense. I guess, are there sort of businesses where in a position where even if they could get the money, they shouldn't?
I mean, if the business is able to service the debt on the loan, that's kind of what we look at. And if it's not able to service the debt on a loan, obviously that would be a situation where, financing would not be prudent. So those are some of the things. And also there could be a combination thereof, meaning the seller provides some sort of seller note on top of whatever we lend to the buyer. So it could be a combination of different, different debt for a buyer to be able to leverage. And, we're really talking about return on investment. If you're buying a $10 million business and you have to, let's just say, put $2 million of your own money in, and you could get, 200% return on your money. So debt, I know some people are debt adverse, and I get it. So maybe, in a situation like that, have the buyer could not leverage 80%, maybe leverage 50% or something like that. And we work with a lot of independent sponsors that even though 80% leverage is available, they pare it back a little bit, and they put their own cash in, and also a combination of cash, seller carry, and the financing vehicles that we offer here at eCommerce Lending.
Good. So let's just unpick a couple of things, which particularly for British or non-American listeners might be a bit of a mystery word. So seller note doesn't mean a little note you write to somebody saying, congratulations, you've sold it. So that means it's a particular thing in America, financial world, doesn't it? Which is not a phrase we use in Britain. So can you explain what that means?
It's seller financing. Basically, the seller, instead of, let's just say on his exit or her exit, instead of getting a check for $10 million, if there's a seller note for $2 million, basically the seller is lending the buyer $2 million. And now the buyer makes payments on that loan to the seller over a course of whatever, 3, 5 years, 10 years, whatever the term is. And it's very common here in the States. And actually it oftentimes allows a seller to exit for quite a bit more money than not offering a seller loan, what we call a seller note.
Yeah.
It's very common. Probably 95% of our deals have some sort of seller loan, meaning that the seller is giving a loan to the buyer. They're getting a little bit less money at exit, but at the end of the day, once that loan's paid off, they're getting a lot more money than they would ordinarily.
Great. So I guess you just partially answered the question of why on earth would you want to do that? I guess, more money overall as a deal size. So what are the pros and cons? So the pros, obviously more money. What are the other sort of pros and cons of offering?
The cons would be that you have no recourse. If the buyer were to default on that loan, generally there's no recourse. So it could be where the seller doesn't run the business in the right fashion and can't pay that note. There's very low recourse for the seller. The pros for the buyer is that the seller still has a vested interest in the continued success of that business. So post acquisition, the seller is going to be a lot more engaged during the transitionary period. And generally there's a 6 month to 12-month transitionary period between buyer and seller. Obviously the seller has quote unquote skin in the game. they're going to be a lot more attentive to the
Yeah.
continued success of that business.
So I guess what I should have, and I guess I'm automatically veering on the side of selling, because I know so many people have sold their businesses, and I know few people, like one or two, who've acquired businesses in the e-com space. So yeah, I suppose I should have said pros and cons, but I mean, yeah. So in other words, for the buyer, that's a pro. For the seller, it's a con to have more vested interest, I guess, if you want a clean exit.
Right.
But it's very interesting.
And also the seller is going to get less money initially from that exit, but over time, they're going to get more money. So
yeah, so I guess you got to weigh up the risk reward equation there, and I guess it depends partly on the seller's personal financial position, right? If they've sold off their mortgage and they've got enough money to retire, then if they can make extra money on top, that's a bonus. And if for whatever reason the deal falls apart, then it's not a disaster, right? So I guess is those the sorts of factors that people put into play when they make that decision?
Also, tax-wise, sometimes it makes better sense for the seller to offer a lending vehicle to the buyer, because ultimately, that, in my example, that $2 million doesn't get taxed. So there are also some tax strategies behind that as well. We've had deals where the seller is offering 30-40% loan to the buyer because they don't want such a significant taxable event in 1 year. They want to kind of drag that on for maybe 5 years. And here in the States, the more money you make, the higher the tax rate. So it makes sense oftentimes to leave a little bit of money on the table so you're not getting whacked by the high taxation rate of, in my example, of that $2 million, and where it's spread over time.
Yeah, so tax strategy really does come into so much of life, doesn't it? And we tend to ignore it, but that's a very interesting point. That I mean, I guess hesitant to quote Robert Kiyosaki to a finance specialist, because he's kind of an interesting figure. But anyway, I would say this, that he says debt is a really great thing for minimizing tax, and he has a fair point. I think this is one subset of that general principle, right? So I guess that one thing you've got to do anyway is, as you say, get a good bookkeeper, but also great, and which is not the same, great tax accountant who really understands the business in your districts, right? And debt strategy, exit strategy, tax strategy, I guess, have to all tie in together from what you're saying, which makes so much sense. But it really helps. As soon as you said it, it seems obvious, but it's like a lot of wisdom. Hadn't really thought about it before. And yes, I know a few people who've sold businesses, and some of them have regretted their lack of tax strategy, because I don't even know exactly how it works with really big deals and the taxation side in the UK, because I've not had the luck of selling a big deal myself. But certainly I know some people who said they realized in retrospect they could have saved themselves several $100,000 in hard-earned cash. It's not abstract, right?
Well, Michael, even on small deals, for example, here in the States, if you sell your business as a stock sale, your tax rate's far less than it would be on an asset sale.
Okay.
So that's one thing. And so it doesn't have to be, let's just say, a 7-figure exit. Even for the smaller exits, definitely, talk to a tax strategist, because the way you sell your business can really impact your taxation. And even for a smaller purchase, I would definitely spend a couple $1,000s to get some tax strategies in place before you exit.
Yeah, and you talked about tax strategies and exit, and actually, and you mentioned pretty early on in the show that you tend to plan 1 to 2 years in advance of the exit. And I would say the same with tax strategy, actually. And if you can combine the two, that's a beautiful thing, because you're saving crazy amounts of money. I guess we all forget that we tend to have this relationship with the government where we think, well, tax is inevitable or just something that a specialist will deal with. And I guess it's neither, right? And that seems to be what the experts tell me. Yeah. So that's very, very interesting and very worthwhile advice. Thank you for that alone. Now, you mentioned finances as one of the key things, obviously, people look for in a business. But again, if we're coming back to the question of, it's sounding more and more desirable, I can understand why you want to do all these things. What else do people look for in businesses when you think about lendability for this kind of deal?
Primarily the type of lending we do is cash flow lending, meaning how much net profit does a business make and can it service that debt? So that's primarily what we look at. We also look at the viability of the business. If it's a business that's involved in anything that's kind of trendy, we kind of shy away from. So those are some of the things that can make or break the ability for a seller to be able to have financing in place for a specific buyer. So we look at that, and we also look at historical earnings, not just what's happened in the last 12 months. We generally look at what's happened with the business the last 2 years, or even sometimes 3 years, depending on the size of the deal. So those are some of the things we look at. And we look at trends, Michael. You know, if a business has year-over-year decline in revenue, you know, are we trying to catch a falling knife? So those are some of the things we look for. Now in the e-commerce space specifically, you know, most businesses have really high year-over-year growth. So generally we don't run into that, but recently we ran into a business that had a little bit of a COVID bump, and it's coming right off that bump, and it's been tough to get financing in place for that person. So so those are some of the things we look at.
Yeah, interesting. And that sounds again like a subset of business valuation. I guess if you're buying a business now, it's the net present value, isn't it? Really, no ecom businesses seem to be valued on that. I remember Jeff Bezos saying, if we have other ways of valuing businesses and we can take net present value, we'll take the net value of future cash flows, I guess, is the traditional rational way of valuing stuff. But it tends to be on a multiplier these days, doesn't it? It's a multiple of trailing 12 months profits, and what that doesn't imply is the buyer's view of the future. But obviously they're buying the future, as a very wise investment banker put it to me on the show. So I guess that implies they've got to have some faith that it's going up, or at least at the very least stable, right? And it's a very, very good point. Right. That I suspect post-COVID, that's a big thing. I mean, this year, a lot of my clients in the mastermind who did whatever, say $10 million in the COVID sort of lockdown period, maybe you're looking at, I don't know, whatever, fall of 30-40% from that in some cases. But also, depending when you're listening to this, I mean, if this is going out in the podcast, that might be out there for quite a while. If it's mid 2023, hello future, be great if you could pick up the phone and tell us how solid this recession is in the USA / in Europe, because it could be pretty major and pretty sustained, in which case this year-on-year decline thing is something a lot of us are going to have to deal with, isn't it? I mean, is this something you've been in this space for a long time? How do lenders deal with that kind of situation where there is obviously a value to the business, but it's not obvious on a growth trajectory? How does that get assessed?
That's a really good point. And, everybody's talking recession. Obviously that comes into place. At the end of the day, if the drop off is mild, let's just say 10%, then it's really doesn't raise any eyebrows. But if the drop off is 30 or 40%, lenders are going to pull back. They look at risk. All lenders look at risk, and if there's a risk for the business to revenues to decline significantly and not meet their debt service requirement, then that's an issue. One thing we found in the e-commerce space, as you know, Michael, is that even though we may be facing a recession, all retail sales, e-commerce retail sales continue to increase year over year. So even if we see a dip in terms of all retail sales, there's a possibility for that really not to affect overall e-commerce retail sales. I mean, I think we approached $1 trillion this year in e-commerce retail sales, or this past year, e-commerce retail sales. And I think it's about a 50% increase over the last 3 years. So again, all retail sales go down, but e-commerce retail sales may even go up during a recessionary period.
Great. Last question then before we sort of begin to wrap things up. What are the non-financial things you look for in a business sense? So you talked a lot, understandably, about finance, and it makes total sense. What are the other things?
And one thing to note on the larger deals, sometimes we look at it subjectively. We recently had a business that's an apparel business, and our credit fund just didn't. They don't think it's sexy enough to lend on it. So there's a little bit of subjectivity to any sort of lending decision on the larger deals. And we've had a couple of instances of that. And we look for growth trends within that segment. For example, pet product businesses year over year are just exploding. Even though competition's increasing, And that's a very desirable segment, as is anything related to health, Michael. So we look for growth trends within a specific segment, whereas other segments may not be doing as well.
Yeah, that does make sense. So there's a sort of objectivity about the market data, and then there's subjectivity about particular businesses. And yeah, I can understand. In the end, a lot of significant things in life are incredibly subjective, and that's the balance. It seems like finances has got a rational basis compared to a lot of ways of running a business. And as you say, the smaller business owners tend to be pretty shaky on their financials. But nevertheless, there's always a personal judgment involved, isn't there, with this stuff, really, it seems.
I would say 80% boils down to the financial picture of the business, and maybe 20% of subjectivity.
Okay, well, thank you. That's a nice sort of rule of thumb. So the 80-20 rules apply. And so if you got solid financials, you're probably going to be pretty lendable by the sound of it, to put it in simple terms. So let's just quickly summarize for the listeners what it is you do for e-commerce business owners, which is the focus of this episode. We're going to do a quick episode about the buyer's perspective, which is a very exciting opportunity. But from the seller's perspective, what do you do to help them? What services you offer?
The key is that we consult them, typically in a financial way, to be able to put their business, pre-qualify their business prior to their exit. And then once they once they go to market, then we help vet the buyers that are interested in buying their business. So those are two key things. Oftentimes we provide them with a level of support in building their exit team, introducing them perhaps to accountants or bookkeepers, but really being able to really shore up their financials, their information. And typically, again, sellers, even on the bigger deals, sometimes their financials are not put together very well. So we assist in that. We have strategic partners that help our clients accomplish just that.
Nice. That sounds really, really good. So if people want to go any further in exploring this, obviously the big decisions, I'd be quite surprised if somebody just kind of clicks on something in the show notes. By the way, they are folks at 10kcollective.com. But I kind of surprised if they click through and just apply for a $10 million loan. That would be kind of escalating swiftly, but presumably there are some interim steps. So what ways can you offer help to people who want to explore this further?
For any of your audience members that are interested in reaching out to us, you could actually reach out to me directly at Stephen@ecommercelending.com, and that's Stephen with a PH at ecommercelending.com. And we'll set up a Zoom call and discuss your goals as a business owner in terms of your exit, and we will be more than happy to assist you with that.
Sounds great. And I think it's sort of thing. And I mean, so just to be clear, so who should and shouldn't get in touch if it's below 5 minutes? So from what, about $500,000 in enterprise value upwards if you're US based, is that right?
Oh, yes. So that's about right. Yes, $5 million US dollars. Obviously, if it's British pounds, it's less than that, but that will be able to assist you.
And then if it's above about what, did you say $7 million anywhere in the world, basically?
Generally, we're working with English speaking countries, not exclusively. So it's kind of case by case basis. Obviously, UK definitely, Australia, New Zealand, etc. Yeah.
Okay, so the sort of AUKUS countries without being political. Yeah, great. Okay, well, thank you so much for that. We're going
to I don't know Spanish, for example. So
yeah, right. Yeah, and also I guess that it's interesting that my understanding of the sort of financial culture of those countries is they have some degree of similarity. They're a bit more risk on. They have more sophisticated lending systems relative to, say, mainland Europe. My understanding is that that's more conservative space, shall we say, in terms of debt. So it's probably a different culture anyway, which doesn't mean if you're German and you listen to this, and if in doubt, talk to an American about lending, because you might find some opportunities that you didn't know existed in your country. But yeah, it sounds like English speaking countries with a substantial enterprise value. And I guess to simplify this down, the last point, if somebody's looking at $5 million, so about, sadly, because of the exchange rate, about £4 million enterprise value, and they just know their revenue, and hopefully they know their pre-tax profit, EBITDA, SDE, whatever you want to call it, how are they going to get a rough handle on whether it's the right kind of size of deal?
I didn't follow your question.
Sorry. So if I'm listening to this and I own a business that is doing about $5 million dollars in revenue, but I don't know what the enterprise value is. How do I decide whether I should get in contact with you or not is the basic question.
I would err on this, just contact us, we'll discuss it. And if it doesn't make sense, then that's fine. I mean, there's no harm done.
Brilliant. So that's
I think the key for your audience is to look forward. Oftentimes sellers don't, even they don't think about their exit until they're ready to exit. We're trying to educate our clients. Think about you need to plan your exit. You can't just like one day wake up and say, yeah, I want to sell my business. You got to plan forward, and typically a year or two out, and it's going to pay dividends when you go to exit. If you plan for your exit, you have to plan for your exit.
Great. So very good thought to end things with. So if in doubt, reach out and plan in advance, get the expert help. Well, certainly a lot of expertise coming through very clearly, as you'd expect of a veteran in the lending space. So Stephen, just remains for me to say for this episode, many thanks for coming on the show and sharing your wisdom.
Thanks for having me on, Michael.
Pleasure. Good, that's that one done. Let's see if we can, have we got time to nail a sort of quick 15-minute episode on the buyer side?
Sure.
Let's do it. Ladles and Jealous Spoons, welcome back to the 10K Collective podcast for 6, 7, and 8-figure Amazon private label sellers. Today, we're talking to Stephen from eCommerce Lending. Stephen Speer is a veteran of the lending space, and his company, ecommercelending.com, has lent over $300 million to e-commerce businesses. So there's huge wisdom here. We're talking today about how you might want to acquire a business using debt, which is certainly a topic we've never discussed before. So Stephen, welcome back to the show.
Thanks for having me on, Michael.
So give us a flavor of what we're discussing. I know you've got a story about a Texan business owner that was looking to add on a competitor. So that might be quite instructive to get our heads around what we're talking about here.
Well, oftentimes, in the online space, quite a bit of our clients are looking to acquire businesses. And in terms of the example I gave you earlier, we had a business in Texas where they had an opportunity of acquiring their competition. And it was very much a kind of a plug and play angle. And their competitor is actually bigger than them. But that's one example of being able to grow one's business. And oftentimes it's a situation where you have economies of scale. The businesses are run essentially the same. So you can really get growth through acquisition as opposed to trying to do it on your own. And oftentimes our clients are what I call acquisition entrepreneurs. They're acquiring businesses, and putting together a portfolio of businesses, typically of businesses, Michael, that are run very similarly, whereas it's not where one business is a service-based business, another one is, more of a product-based business. But generally, the businesses do kind of match up, and that's what they do. They grow them, and they eventually sell them as a whole.
Makes sense. And I guess the obvious reason for doing it is what speed of growth, or is it just what are the sort of actual motivations for people who do these kinds of deals?
Speed of growth. You're not having to recreate the wheel. You're buying something that's already in place and then growing it from that standpoint, obviously. And also when you combine businesses and grow that way, generally the multiple increases on your exit, as you probably already know. So it's a good way, it's a good strategy to ultimately grow a portfolio of businesses and then eventually exit with all of them.
So it's interesting that I'm used to talking to Amazon aggregators with the mindset and on behalf of people who own individual businesses. And I suppose what you're saying is, why not become the aggregator and, right, put together a bunch of businesses of similar type, so you get economies of scale, you can quote plug and play. My understanding of speaking to aggregators who are honest, at least in private, is that it's not always as plug and play as that. I mean, I guess that's not your problem because you're not the operations focused guy, but is it really as plug and play from your sort of outside perspective?
From what we see, but there's a little bit of difference between aggregators and what I just described. if let's just say you have an FBA business and you're wanting to expand that business by acquiring other businesses, that's a little bit different than being an aggregator and say, okay, all right, let's start buying businesses. So another thing is that generally aggregators, as we were finding out, might not know exactly how to run online businesses. And whereas if you're already running an online business, you know the landscape, and you're acquiring something that's going to be run relatively the same way, it's a lot easier than just coming in from the outside and just acquiring businesses and then putting together a team that way.
Interesting. So I guess what you're saying is that we actually could do a better job of rolling up businesses than the aggregators if we have that e-commerce operating experience, which makes a lot of sense.
Right.
It's just not, it's a very bold thought for me, but I mean, actually, there's no reason why you shouldn't do it. So, okay, the next question then, assuming that we desire to do this, and it's certainly, I can see why it would make sense, once you've got your head around it, how do we get ourselves in a position to do this? Because presumably lenders aren't going to lend to just anyone when they're trying to acquire a business. I guess, how do we get in a position to do this in the first place?
Well, that's a really good question, Michael. Most of our clients come to us before they start their search, and we pre-qualify them as a buyer. And then now they know their parameters and they go out and start searching for businesses. Also, we have, we're very well positioned to know what businesses out there are available, even if they're not technically for sale. But we also assist buyers in that respect, where we kind of become their buyer agent. And for example, we had a client interested in outdoor furniture products. Well, we happen to know of a seller or someone that would consider selling outdoor furniture, and we're able to kind of play matchmaker and consummate the transaction. So, but ultimately it boils down to pre-qualifying that buyer. And what things do we look at? We look at personal liquidity. Also, is the buyer putting together a team? Meaning, is he going to have partners, or is she going to have partners in the acquisition? We kind of lay that out for them, and then they start their search, and we help vet businesses that they're looking at or interested in, and make sure the businesses themselves qualify for financing.
Okay, so this is like the other side of the previous episode where we talked about, as a seller, making sure your business qualifies for financing. So you're talking about the buyers, the acquirers are making sure they personally, or that their business, the acquiring business, buying company qualifies for financing. And then the other side of the equation is the target businesses, that's the jargon, also needs to qualify for financing. Is that right? Do those things both have to stack up, or is one or the other acceptable?
As I mentioned in a previous episode, unlike when you acquire a property where it's ultimately, does a buyer qualify to buy that property? In business acquisition, the buyer has to qualify and the business has to qualify for financing, so separately. So we take care of the first piece up front, and as a buyer begins his or her search, we assist in vetting the businesses that he or she is looking at, to make sure the business itself qualifies for financing. And sometimes businesses don't qualify for financing, and they're not going under contract or under letter of intent, and then realizing 6 weeks later that the business itself doesn't qualify for financing. We do that up front before they get, before they move forward with any potential acquisition.
Nice. So what I'm understanding is you pre-qualify the buyer. So it's a bit like if I'm going to go shopping for property, like a house to buy, either to rent out or something, which my wife and I did a while ago. We know roughly what size of deal we can look for, because we've got the financing pre-agreed, and also that the sellers will take you seriously if you say, yeah, the financing's in place and we have this much cash. And then you guys also save the buyers wasting time by making sure that the properties they're looking at, i.e. the businesses, are actually lendable, basically. Is that right?
Correct. And also sellers, especially these days with as much activity in the space, they want to see a letter that they're qualified for financing. And that's one thing that we provide, either with, directly to the seller, or if there's an intermediary involved, a business broker involved, we provide that letter to that business broker. So nobody's wasting time. And then again, as they search for a business, and searching for a business is not easy. It takes months. We're able to vet businesses as the buyer, businesses that the buyer is interested in. So
yeah, I imagine anyone you can help with the matchmaking and the search, the qualifying, all those awkward parts. I remember speaking to a guy who's a private equity background in deal making. He said, in private equity, I have a saying, making deals sucks. So we try and make sure we don't have to do it more than once, So I guess, if you guys can save that pain. What are the things, just a final question before we start to wrap up. What are the other things that a potential acquirer, business owner, should we say, somebody who wants to acquire the businesses, needs to start putting in place in order to be in a good position to do this?
It depends on the price point, but the things that we look at is business acumen, and we look at personal liquidity. And if they don't quite have the personal liquidity, they need to think about, okay, maybe I partner up with somebody who may have more liquidity than I do, or something like that. Really putting together their acquisition team, if need be. So those are some of the things, and trying to do that up front. And we've had clients that really didn't initially think about putting together some sort of partnership with contacts they had, but at the end of the day, they ended up doing so because they were able to acquire businesses that are a lot larger and get a lot more return on their investment than if they went solo.
Yeah, I guess that's just a general rule of business and life, isn't it? That equally, suddenly you're dependent on the quality of your partner and partnership. And yeah, they say you can't do a good deal with a bad partner. And by the way, you're often the bad partner. I can certainly look about my business career and guiltily admit that. So again, I guess there's something you can also kind of have a quiet word with your client about, right? Like whether the suitability of some business partners, is that something you also get into private conversations about sometimes?
Generally, we stay out of the partnership discussion, other than just recommending. It might be a situation where one person has really good business partner or business acumen, but might not have the personal liquidity. So who could you bring in that has that liquidity and not necessarily has the acumen? So we strategize around that, but we don't get specific. I mean, we're not interviewing people to we don't play partner matchmaker at all.
Yeah,
that's something we shy away from.
Yeah, I always feel like getting involved in partner arguments is a bit like coming between a married couple argument. So you're well out of that discussion for sure. Having had multiple discussions over the years with the clients who've got problem partners, but nevertheless, I mean, it's a very good general point that
and sometimes sellers, Michael, they say, well, gosh, why should I bring a partner in? I'm giving up equity. Well, 50% of something a lot larger you could get quite a bit more return on your investment than being, wanting 100% of something. So oftentimes partnership, obviously you don't want to partner with somebody that you don't know. But oftentimes partnerships is one strategy that really works for a lot of our clients.
It makes sense. And I think ultimately any significant size businesses involve, if not exactly partnership in the formal legal sense, certainly multiple actors, shall we say, people you help, a team in the broader sense. You've got to have an accountant. You've got to have probably some kind of advisor on marketing and branding. If you're serious, you've got to have some people who know about supply chain more than you do, because I'd be amazed if you know more than a supply chain expert and so forth. So yeah, in the end, it takes a village, they say, doesn't it? So to put these things together.
And that's something that we really tout here in e-commerce lending. We help quite a few of our clients build their acquisition team. It could be an accountant, it could be certain tax strategies in place, it could be a due diligence company. So when they do find that right business, they're able to move forward on due diligence very quickly. So we often tout that most of our clients need to build an acquisition team to make sure they do it right.
Yeah, that totally makes sense. And that's not the same as giving up ownership or equity, is it? That's just about being willing to be humble, to admit you don't know enough and get the experts in. Talking of which, just remind us what you do for people who are potentially wanting to acquire e-commerce businesses using lending and debt as part of the picture.
Ultimately, I mean, they could reach out to me at Stephen@ecommercelending.com. It's Stephen with a PH at ecommercelending.com. We'll set up an initial consult, probably via Zoom, and then we'll just start a dialogue. And that's where we kind of start with our clients. And again, we generally do that well before they start their search.
Makes sense. And all I would say to anyone who qualifies, and I believe it's like below sort of $500,000 enterprise value upwards of the US, or in English speaking countries, around about $5 million enterprise value. And if you're not sure what your enterprise value is, get in touch with Stephen, is what you were saying. And I would just say this, talking to an expert does not oblige you to work with them. You can tell that Stephen's kind of relaxed guy. He's not going to lend you a lot of money overnight anyway, because that's not how it works. So I would just say talking to an expert and educating yourself, exactly as we're trying to do right now, it is always just a wise move when you're dealing with big numbers. So Stephen, final thing to say is thank you so much for talking about education. Thank you for coming and educating us on this fascinating topic, and what I think is an amazing opportunity for the right people.
Michael, thanks for having me on. I appreciate it.
My pleasure. Okay, so that's our podcast done, folks. If you've been watching live or on the replay on one of the social media channels, feel free to pop some intelligent comments or questions about the topic, which is lending for acquisition or exiting a business. So quite specific. Would love to hear your thoughts, comments, and questions. Meanwhile, thank you so much for being on live with us. And Stephen, thank you again for being on live with us as well on the 10K Collective podcast.